this whole construction of the industry is set up around founders. And at the end of the day, it's up to the founder to run the company, and they get to do what they want. Unless they do something criminal. Otherwise, they're going to be able to do whatever they want. And
I disagree.
Hold on. Boards generally are very deferential to founders. And if the founder's not willing to listen to advice, what are you going to do about that?
Well, this is the point you're making, I think, is not right. You think that if Peter Thiel gave some advice to slow the company down, that this guy would have not taken it? Of course he would have taken it.
I don't know. I don't know about that.
And we would have had to consider it. If Mike Moritz actually said it, he would have had to consider it. I think what you're actually speaking to is in the rush to put so much money to work, we've elevated people who don't understand what the job is to do the job. And if they're not credible, of course they're going to be ignored. We all have ignored stupid board members. You've done it too, David. But even, let's actually look at Yammer as an example. There were one or two of us that you would talk to pretty consistently. You didn't talk to all of them.
I would always seek out advice. Look, a good founder always seeks out advice. No question about it. But look, this idea that it's governance versus advice, I mean, the problem with it being governance is all the institutional incentives for VCs are to be pro-founder. So no one wants to jam a founder by making them do something they don't want to do. Well, I'm just saying that's the way it is now.
By the way, no, to be clear, that became a competitive tactic that emerged as more venture capital funds were raised and more venture capital was raised from LPs. Prior to that, there was a scarcity of venture capital, and VCs could have good governance and not have to have this whole pro-founder model that became the thing that Founders Fund and Andreessen and others kind of proclaimed as being core to their advantage and the reason to pick them over some other VC who's going to meddle in your affairs. And by the way, both are true. There are most VCs, as Vinod has said publicly, add negative value, and I totally agree with him on this because many VCs, particularly the ones who aren't, valuable and don't really have much to add, try to add stuff, try to say stuff, and they just, create negative value in the process. But on the other hand, the whole pro-founder model led to the WeWork and Ubers of the world that, I think we
That's
all
right. There's a trade-off. I mean, look, I remember in the 1990s, the default was that the founder just got replaced. Right? As soon as the company's successful, you hire a professional CEO. That was just like rule of thumb.
Eric Schmidt. I mean, even the mighty Google did that.
Yeah, no, I mean, by the way, that was the point I was trying to make, which was like so much of John Doerr's influence was in getting Larry and Sergey to take Eric on as CEO. And I really do think that was like, a critical move that created the most valuable company in history.
Right.
And, it was an important, imagine if you had one of these Founders Fund, and by the way, as you guys know, I'm very close to the guys at Founders Fund. And, but imagine if you had a Founders Fund type approach where you said, look, Larry and Sergey are the founders. They know what they're doing. Let them do it. As opposed to the John Doerr nuance of let's make sure that we think about the development of this company successfully over time. And then convince Larry and Sergey through a bunch of meetings and riding bikes and whatever else they did with Eric, to like, and then what about Jim Breyer? Didn't he bring Cheryl over to Facebook? I mean, like, there's a lot of these stories of the really, the VCs that really changed the trajectory of the business through their work.
Right. But look, all I'm saying is the good VCs can still have that influence, but it's in the form of advice rather than governance.
Right.
Look, we just don't call the shots.
No, you're right. You're right. It is advice. But for example, governance, as an example, in every board that I take, the first thing that I say is, here's a template I want. I'm not going to ask you a bunch of stuff, but I just want some transparent reporting. And the first page is always, how much money at the beginning of the month? How much money did you burn? How much equity did we give out? How much is left in the pool? Simple, basic checks and balances, right? Where you're not asking all kinds of crazy questions. You're just like, all right, how much money are we burning? How much dilution did we take? Now tell me what we've done. And those are simple elements of governance. Way before you get into advice.
Basic level setting. What's the speed of the plane? What's the elevation? Where are we at? What's the altitude? And when you ask people for this today,
we actually do that too.
Yeah, I don't know anyone that doesn't do that. I'll be honest.
Anybody that doesn't do it, honestly, is being
that's not what we're talking about,
irresponsible.
I don't know anyone that doesn't do that. I mean, I'm talking about.
I would love to see a fast board deck.
There's a little bit of that going on. I would love to
see a fast board deck and to see if that first page is that page, the first page. And by the way, you know where I learned that from? From Sequoia and Kleiner Perkins. Because back in the day, what I saw from founders was, this is the first thing I have to report on. I was taught by founders when I was a principal at Mayfield. They're like, this is how you do the job. And I was like, great, thanks. I was, sitting beside these guys that were old hands at doing it. And that's how I learned this business through that apprenticeship. But there was governance and advice. And the governance is just about being transparent about how much money are you burning. And so you can't, to David's point, if you had just seen that data, even if you take those board decks, by the way, because you have these information rights, I don't know about you guys, but we did it as well. You take the board deck, you circulate it to your other partners. There's lots of times where I see board decks in companies where one of my partners are on the board and I send them an email of like, hey, here's some bullet points of things to think about that I've seen before, et cetera, et cetera. You don't think nobody at Stripe or Index could have said, you're burning $10 million a month and there's no revenue? So the point is that data was not there.
And there's only $30 or $40 million in the bank.
Give me a break, guys. So this was a cataclysmic failure at the advice level and at the governance level. And all I'm saying is it's a good lesson for folks to learn.
Absolutely.
Yeah. So let me point people's attention to 2 articles I wrote that I think are relevant. So first, we actually published an article on the SaaS board meeting deck that we would like people to use. And obviously they're free to use it or not. To Chamath's point, right up at the top as a context setter, we need to know what's your monthly burn and how much money is in the bank. And then we just divide those things to create runway. We don't like looking at projections for runway.
Totally.
We just look at how much you burned last month and how much money you got in the bank.
Months
and like
to cash out.
Right,
Months
exactly.
To cash out.
And when they were down to $30 or $40 million, burning $10 million a month, somebody should have thrown up a red flag and said, you better slam on the brakes right now because you're going to be out of business in 3 or 4 months. So that's sort of piece number one. The other piece was an article I wrote a couple of years ago called Blitz Fail, which is how not to go off the rails, because there's a lot of literature out there about blitz scaling. And a lot of startups think they need to scale as rapidly as humanly possible. And I wrote this piece about how fast-growing companies that raise lots of money at high valuations basically go off the rails and they end up imploding. And there's 11 reasons why this happens. I sort of categorize them. One of the biggest ones is founder psychology. You have a founder who believes that things are always going to be up and to the right. It's funny. They're always described the same way. They're described as visionary, charismatic, and the word crazy is often used, but it's crazy good. And then when everything goes to shit, all of a sudden the word crazy means something pejorative and bad. And, the problem is that, these characteristics of being highly visionary and charismatic, they also can be combined with an unwillingness to listen to advice. And so, founders who have those qualities, they can be a good thing, but they have to seek out advice from people who've had experience. Otherwise, they're going to make a mistake and hit the wall. Being
delusional is, what you need to start these companies. Like, I'm going to beat these incumbents. I'm going to change the world. A little bit of delusion is good, but not when you're looking at the runway, right? Like, that's when you need to be pragmatic.
I think, there's a term of coachability. How coachable is this person as a CEO, as a leader? And I do think that coachability goes hand in hand with intellectual curiosity. I mean, if you look at the Collisons, Patrick Collison, and how much breadth he has in some of the topics he's interested in and the things he writes about, it indicates to me a high degree of intellectual curiosity. And people who are intellectually curious generally are very humble because they're constantly seeking things they don't know, and they recognize that they don't know a lot of things. And in that same kind of mentality, they are willing to recognize that other individuals can have good points of view that can inform their perspective, and they're willing to change their perspective. And I think that's a really key thing, that if you look across the range of successful founder CEOs that scale to $100 billion plus valuations for their businesses, that to me is one of the more common threads, is this kind of intellectual curiosity, which translates into a coachability, which translates into an adaptability and being willing to take advice. And so your board is a tool, not kind of a governance structure sitting over you. I think the less you are like that, the more you are likely to feel like your board is a governance structure, an umbrella sitting over you, telling you what you can't do.
I don't think that's what governance means, by the way.
Well, governance it's meant to look out for the shareholders. That's the job. Right.
Sure, but to act as a fiduciary doesn't mean to tell the CEO what to do. This is my point.
I'm just saying.
So it's not.
No, but I think he's right about. I think Friedberg's right about how boards are often perceived by founders. I think there is an increasing, let's call it a Hollywood director, a Hollywood auteur mentality towards VCs.
Jake Cal on the All In podcast, right?
Well, it's basically look, there are certain incubators out there and accelerators and whatever who teach these young founders that it's all about their vision, and anyone who stands in the way of it is basically interfering with them.
Right, totally.
And they are the auteur, like a Hollywood director, totally. And you got to stay away from those suits, the studio guys, right? That's the mentality they're trying to They're teaching them
an adversarial mentality.
An adversarial mentality. And look, there are, to Chamath's point, there are plenty of VCs who don't know what they're doing. They have no useful advice to offer. But the better mentality to teach a founder would be like, look, the world is so complicated and building a company is so complicated. It's going to be 10 times more difficult if you don't seek out advice. So go find board members who will let you ultimately do what you want, but will still give you the advice if something's going wrong.
And what was true at one point in time when Paul Graham gave this advice and he set up Y Combinator, you don't want to say their name, but it is Paul Graham had a terrible experience in his company with venture capitalists. So he set up that wartime stance between founders and the investment community. And, Founders Fund became the antithesis of the traditional venture funds, and they were going to be founder focused. So, but that advice then might have been true, and now it's not. Now we've swung the pendulum too far the other way. We did two things because we saw this 10 years ago when I started seed investing. And then when I started building positions of over 5%, I just said to founders, if we own over 5 or 10%, we should have an option of a board seat, and we'll do board training with you, where we'll just teach you. We'll take here's some decks that we've seen from other, here's some decks that are available, and we'll show you what a board is like. And then I would have 3 founders come, 2 would sit on one's board meeting, and I would do 3 back-to-back board meetings, bring your counsel, bring your founders, and sit in on the other 2 board meetings, and we'll have a little Socratic discussion about what was good about each board meeting. We did board meeting training as a proxy for venture worthiness later on. And when those companies did go out to get venture and they had an ESOP and they had board minute meetings, they just looked more impressive to the venture community. So I know people say, don't do a board, it's not cool. It actually turns out doing a 1-hour board meeting 4 times a year, 6 times a year, even as a seed stage company, it does differentiate you to the venture community, I find.